Hello, hello, hello. Welcome to our stock trades. How's everyone doing? All right. So let's go ahead and cut the music off. All right. So first things first. Again, not my background, as you know. I'm actually not in my YouTube studio right now, but I did add a microphone here, so hopefully the audio is okay. I'm exhausted. I've been working relentlessly. Just wanted to give you a couple of updates. And as the title states, we're going to go ahead and listen together to the Wells Fargo 2023 Healthcare Conference. Please let me know if the audio is doing good, and we'll go from there. I want to go ahead and do a couple of shout outs real quick here. So we're going to go ahead and do this, and then we're going to look up a couple things on the stock terminal. But first, I'm actually really proud of this. So I recently published a book on Hi Al. Audio okay? Perfect. Okay, good to know. Good to know. Thank you so much. Yeah, exactly. It's doing pretty good, man. This is very good to see. This is exactly what, we want to be buying at these prices, in my opinion. I'm very excited for this opportunity. We know they're going to become profitable. I just remembered I need to talk to you about seasonality, which I do have a graph for. Okay. So what do I have up here? Well, this is my book. I just published this book, and by golly, it just became in the top 100 bestsellers on Amazon's investment analysis and strategy, and also the top 98 in stock market investing. Like, holy moly, my book is literally it hit the top 100 record. I'm getting sales from all over. And just to basically clarify with you guys, all profit proceeds will be donated to charity. This will be donated to essentially fund research in low GDP countries. But I really want to I don't know if I should basically congratulate myself, or should I be disgusted with myself to be associated with this piece of shit right here? Okay. So again, so I ranked 98 in this, I guess Wolf of Wall Street ranked 97. But again, this is Jordan Belfort. Now, again, the game is the game, right? But again, stealing from people, he served his time. It is what it is. But let's try to beat this guy, and let's get let's go to 90 at least, so I can get far away from this guy. This goes against everything we work hard for our brand, for all stock trades, and it's good to be in this arena, but definitely don't want to be next to this person here, right? This person has scammed investors, robbed investors, and it's a shame that Leonardo DiCaprio makes movies about this. But I guess, people need to learn some way or another. But be as it may, very excited for this effort. And another thing is we're about to publish another book titled How to Find the Next 10 Bagger. And it's going to be a damn good book. It's going to be a damn good book. And again, like always, it's going to help people out. All right. So now that we went ahead and talked about that, I'm really excited. Thank you so much. But the supply of clove is going to shrink. No, hopefully not. No, it's just one book. So we haven't released it on Audible yet. I'm still working out the quirks of it. I think once I publish this next book, I'll learn how to work all the other books out to get them to be read that way. But yeah, I'm very excited, man. I'm super excited. Actually, I might actually put them in the background of my YouTube studio, kind of like hang them up, the hardcover books. It's because they can stand better than the paperback. But I'm very happy about this. All right, so what we're gonna do right now, really quickly, is and I guess I just want one more shout out. I just published a paper in Surgical Neurology International titled Emotional Intelligence in Neurosurgery. So that's like brain surgery and spine, mitigating burnout and enhancing performance. I'm a first author on this. Very excited. A wonderful opportunity. But you don't recall here, there's something called the Global Neurosurgical Alliance. That's an organization that I basically helped started. It helps people in Africa, Iraq, Iran, Syria, Lebanon, Colombia, Ukraine, all parts of the world to help publish and share their voice in the academic field. So I'm helping people in the academics and finance, and it's just wonderful, and in medicine. So now that we went ahead and did all the shout outs, I just came back from DC, just give you guys an update. It's been a while. Just came back from Washington, DC. Was really nice. This is my last shout out here. We went ahead and one of our colleagues here on the channel put the Al stock trade symbol. So we went ahead and we had a dinner at this wonderful place in DC. Interestingly, this is like a private access to this restaurant, and apparently Chamath Palihapitiya goes there. So I was listening to the vibe. There were a couple of rappers there, and I was like, man, this is so Chamath's vibe. So I asked this gentleman, I said, sir, have you seen this man, Chamath Palihapitiya? Like, oh, he comes here all the time. I'm like, yeah. Kind of looks like his taste. Personally, I think this was good, but this is just not me. I like carne asadas, burritos, and stuff like that. Yeah, I like this type of food. These are from our members. I this is my type of food. Not, actually, I actually ate after. It's like, what the hell was this? But anywho, so let's go ahead and do some technicals, and then we'll go into the whatchamacallit platform here. We'll go into the Wells Fargo. So let's go ahead and, oh, by the way, shout out to this person here. I got your book yesterday, immediately started reading it. I'm very excited. This will be a good starting book. Chapters 1 and 2 is great. Chapters 3 to 8 or 7, you're going to be like, what the hell's going on? It's okay. Chapters 8 to 20, you're going to love it. It's going to make sense. This next book I'm writing, it's going to be about 30 chapters. Again, it's very short, less than 200 pages, if not, maybe less than 300. And it's going to be very, very good. It's going to pretty much show you the way, right? It's going to show you the way, right? And then obviously the mastering and all that is going to basically put the nail in the coffin, all right? So let's go ahead and let's open up the chart here. Let's do a chart analysis really quickly. Let's go do Clover. Let's do the daily. And let's go ahead and open up the interactive chart on the stock terminal. So it'll take you to an expiring link. You can click right here. It'll open this up. And then what you can do here is we're just going to kind of make this a little big. And we're just going to go here. So you see this. You see this little blue line here? This blue line is a simple moving average of 200, which is hovering around $1.05, $1.06, which is Clover's basically touching it, right? So remember how I told you about stage analysis, how we want to see, is this a positive momentum trend? Because if this thing bounces and it bounces back up, then we know that we might be in for a positive trend, which means that, as I said, the simple moving average has fallen and now it's leveling. You see how it's becoming more horizontal? You see how it's becoming way more horizontal now? You want it to go fall, horizontal, and then rise, right? That's exactly what we want, right? So we're going to see, and here's a couple of the retracements. You can take a screenshot, do whatever you need to do. And again, if you don't want to access lifetime to this, there's a 7-day free trial at Stock Terminal or lifetime access. With a coupon down below if you guys are interested. So if we see this here, the Fibonacci is around $1.01, right below this 200-day moving average. So we can see that we're testing these lower fibs. We broke down all these other fibs, and on this right side here, you can see the purple resistance lines here, or support, resistance up here, support down here. So and the all-time low here. So, we're going to be watching this to see kind of what happens. The MACD's in a downtrend. RSI is near oversold territory. So we're going to keep an eye on this. All right, so let's go ahead and do a quick Wells Fargo analysis here. We're going to go ahead and stop the share of the screen so we can share the audio. Good. So let's do that. And let me know if you hear the audio. Please let me know. So no audio. I just got your no audio. Okay. Let me see. I'll fix this. I got this. It's been a while, guys. I'm not in my studio, so I want to make sure. I know what I did wrong. It's called a Dumbo mistake here. Let me see if I can get this. Boom. I think so. Let me know. I'm gonna restart it. Let me know if you guys hear it now. Hold on. Let me see.
All right, hey everyone. Thanks for coming to the Wells Fargo Healthcare Conference. I'm Steve Baxter, the Healthcare Services Analyst, and we're pleased to be joined by Clover Health, who's an innovative player in the Medicare Advantage space. From the company, we have Scott Leffler, the CFO, and Ryan Schmidt from Investor Relations. Thanks so much for joining us today. For those of us that are maybe a little bit less familiar with the company, kind of give us a reminder of where Clover sits in its life cycle, like Clover's market fit, and the reason why the company exists, like the problems that the company saw in the MA market and how they responded with a solution that they think responds to that.
Sure. Thanks very much for the question, Steve. Let me start out, first of all, by thanking you, Steve, and the Wells organization for having us here. And for all of you who are either already familiar with the Clover story or looking to learn more about it, very much appreciate your interest in the company. And, this is a very exciting time for Clover. We believe that we are really at an inflection point in our history. We are, just to answer your question at a high level around who Clover is, we are a health insurance company servicing the Medicare eligible population. And we are primarily known in the marketplace for our wide network PPO plans, which provide maximum choice to the members that we serve. Now, in the network, generally speaking, it's understood that maximum choice is something that is compelling to the membership base. But generally speaking, in the industry, the PPO construct is one that is also known to come with certain economic headwinds. And I think the real challenge for us in bringing that maximum choice construct to our membership base has been what is the right tool that we could bring to the market to help to make it a viable business model as well. And that's where our true differentiator really comes in, because Clover has developed and deployed a tool. It's a proprietary AI-driven software tool called Clover Assistant. And Clover Assistant is a physician enablement tool that we've deployed in the marketplace that really helps to take.
Wait, hold on. Okay, guys. So you have to understand something here. This is the first time I'm listening to this with you guys, so I'm gonna go ahead and restart that. I'm gonna restart that. Hold on. Oh, wait a minute. Okay, let's go ahead and restart that. But I don't want to restart too much. Let's go restart that here. They said something important. Let me see.
Really helps to take at the point of care the physician's clinical judgment, which we are effectively investing in, supplementing that clinical judgment with data-driven analytics in a machine learning environment in the form of our proprietary tool, Clover Assistant. Really, in such a data-rich environment as we have today, it becomes more and more challenging for any one individual to aggregate and analyze and process the vast amounts of clinical data that's out there. And Clover Assistant at the point of care acts as a physician enablement tool to help to supplement the clinical judgment of the physician. At the end of the day, one of the ways that we measure success of Clover Assistant is the early diagnosis of chronic conditions to help for a more effective and accelerated treatment plan. Increasingly, we have more proof points around that. Even recently, we published an analysis around chronic kidney disease, where we found that physicians who are live on Clover Assistant were significantly accelerated in their diagnosis of chronic kidney disease, which of course helps for the early treatment of the disease and improve clinical outcomes. So you take.
Yeah, guys. So again, the way they are talking now, they're talking like a good company, right? Before they were scattered, they weren't really attacking the core concepts and really pushing the tailwind that is of AI, right? It had, open AI and Pal, this company, I'm going to push my keyboard here, this company finally is getting in a position where it's actually taking advantage of these buzzwords, because without they are actually using AI. And funny, Andrew Toy a couple weeks ago was like, hey, to all the companies that use AI and say because they have a chat bot that uses AI are not AI companies, and he kind of basically does a really nice funny joke there. But I really want to be clear here, and let's just remove the fundamentals for a sec. Which you're like, wait, what, Al? Your basis is all fundamentals, but let's just push this for a sec, and let me just tell you a story. A long time ago, Warren Buffett, before he even learned about Benjamin Graham, he used to look at the Coca-Cola company. And he used to walk down the street of his neighborhood. And just want you to close your eyes and imagine this, okay? When you go to the EMR on TikTok, they go like, relax. That's what I feel like I'm doing right now, right? Just close your eyes for a second. I want you to like walk down Warren Buffett's neighborhood. He used to look at the Coca-Cola caps on the street, right? And he used to count how many Coca-Cola caps are on the street and say, well, okay, well, if this street, on one given weekend has this many Coca-Cola caps, well, how many streets in America? And at what rate, how many streets in America were there last year in comparison to this year? And let's look at the percentage of growth of those streets. And you could kind of get an analysis, assuming, let's say, give a 20% margin of error of safety to see how many streets drink Coca-Cola. And then that's your discount rate, and then how many streets is your growth rate, which is the amount of Coca-Cola caps is your free cash flow, right? And ultimately, you start seeing that the viability of buying that company is just perfect. Look at iPhone. Everyone has an iPhone, right? Especially it's dominated in the United States. Go and walk on a plane and see how many people are on their phone, right? Go drive, unfortunately, and you'll see people on their phone too. Don't be on your phone, right? What I'm basically trying to tell you here is that we are all going to get old, right? We are all going to get old, and some of us are going to get chronic kidney disease, and God forbid, none of us. But let's say, for example, if you're 50 years old right now and you're hearing this and you're saying, well, this insurance company is going to make you live longer, pretty much. This insurance company is going to help you get diagnosed. What are you going to do? Of course, you're going to choose this company. Of course you're going to choose this company. Who the hell wouldn't want to choose this company? You're telling me if I can live 10, 20 years longer or 10 years longer, 5 years longer because of a goddamn insurance company that uses AI to make my doctors smarter, of course I'm going to do it. Of course. We're talking life here. And guess what? As shareholders, we're going to be benefiting off of that, right? That is a big, big influx. We're getting 10,000 Americans every day that turn 65 years of age. A lot of them, I think they have like 3 to 5 comorbidities. So I think this is good to hear. Okay, so let's go back.
Take this increasing number of clinical reference points as far as the impact of Clover Assistant, and you bump that up against the step change improvement in financial performance of the company, particularly with our most recently published Q2 results, where our Q2 and year-to-date performance for that side of our business really is a step change improvement over 2022, and also now comparing very favorably to other more scaled-up industry players.
No, it's a great start. And it's good timing. It's been, a year since he joined Clover as a CFO. So, from our perspective externally, it's been a little bit of a volatility in terms of the level of growth the company's experienced, both across the insurance and non-insurance businesses. And obviously that's had P&L impacts as well. I guess when you say the company you think is kind of at an inflection point, kind of expand kind of what the company has done from kind of like the market growth and market fit perspective, especially on the non-insurance side of the business, and what you think that's translating into in terms of the potential financial inflection that you're already seeing, and as you hope that continues into next year.
Sure. And yeah, so you're right. I have been with the company now for a little over a year, and really excited. Obviously, when I joined the company a little over a year ago, was excited just about the history of the company, not just in terms of the tool and the value that we believe it offers in the marketplace, but from a financial trajectory standpoint, Clover is a young company, but one that had already proven the ability to deliver outsized growth, both on the membership side and, of course, on the revenue side as well. When I joined Clover a little over a year ago, we also began messaging to the marketplace that having really established the growth potential of the business, we were also looking to establish the profit generating potential of the business. And we began talking more, and this applies to both of our lines of business, both the insurance and non-insurance lines of business. We began talking more about prioritizing an acceleration of the path to profitability as opposed to just continuing to document the revenue generating potential of the business. And what that translated to for 2023 was a descaling of the non-insurance side of our business, which had grown very quickly to almost around 170,000 members as of 2022, down to a little over 50,000 members this year. For that side of our business, really aligning ourselves more closely with those providers that we felt fit with our program of value-based care and deployment of the Clover Assistant tool. But then importantly, on the insurance or MA side of our business, the more moderated growth in membership that we were targeting really helped to allow for the maturation of the membership base and the business model in general. For those who are familiar with kind of the economics of Medicare Advantage, I think you're well familiar with the concept that the more new members you have joining, the more dilutive that is to your profitability at the gross profit level. So by taking a more moderated approach to membership growth for the Medicare Advantage or insurance side of our business, we were able to finally show the marketplace the profit generating potential of the business. We have talked for quite some time about the fact that for the MA side of our business, when we have physicians who are aligned on Clover Assistant, the members that they're seeing are generating over 1,000 basis points of MCR improvement. But again, that effect was kind of lost in the accelerated growth history of the company, where you had all these new members coming in that were kind of offsetting that incremental MCR advantage from the tool. So now here we are in 2023, we've taken this more moderated approach to membership growth, and finally you can see the step change improvement in financial performance that comes from that. And there are a few factors that are influencing that I'm sure we'll get into later in the discussion, but this improved mix of returning versus new members is a big part of that, and it's a reflection of that strategic shift.
No, that makes perfect sense. And you mentioned, the 1,000 basis points. Like as we attempt to think about, kind of the composition of the 1,000 basis points, like obviously there's going to be, cost consideration because you're driving improved, decision making on the clinical side. There's also going to be a revenue component, I'm sure, because getting paid appropriately for the acuity of your patients is a huge part of being successful in MA. Just how do we think about the relative size of those levers compared to each other? Is there anything you can share on that front?
Sure. So a number of drivers that are resulting in this improved performance for the MA side of our business this year. And just as a reference point for everyone, our year-to-date MCR or MLR for the insurance side of our business is around 82%. And again, that is a step change improvement, not just relative to what we have historically reported, but also I think relative to many major players in the industry. It shows really the profit generating potential of the business and in particular the impact of Clover Assistant.
Yeah, so this is exactly, why I got really, really excited about this company. Because if you look at, let's say, if you stack, 10 years of like the incumbents, the dinosaurs, the Humanas, the United Healthcares of the world, and if you compare them to Clover Health, this Clover Assistant technology is actually accomplishing something that has taken these companies ages to basically do, and Clover Health is able to do it just like that. And you're going to see a lot of chartered financial analysts and a lot of analysts, for example, let's say, for example, here at Wells Fargo, start to see, hey, you know what, man, Clover Health is actually making sense. Maybe the non-insurance side was really the kind of the fog between the light at the end of the tunnel. That now that they basically decreased revenue growth, they are now able to basically see that perhaps, this is a sustainable business. Because I was at the Henry about a year and a half ago, and I was talking to a chartered financial analyst. He gave me a compliment. He's like, for you to know Marvell Technologies, you really know what you're talking about. I was like, well, thank you. Right. I usually don't get excited about compliments. Because, in medical school, they pump your butt with compliments. Right. So I'm like, so I don't really, I'm like, but for some reason, when a financial analyst complimented me, a especially a successful one, I was like, oh wow, that's very sweet of you. It meant a lot. He specifically stated that Clover doesn't have a business model. I can't see a business model. Do you think he sees one now? I think it's starting to look clear. I mean, look at it, 82 around approximately 82% MCR. That's better than the incumbents, given where Clover was at a year ago. You understand what I'm saying here? This is there's going to be hospital systems and X, Y, and Z. They're going to want to use the software now. Because again, the software is not an insurance company. It's the insurance company is the insurance company. The software just helps the insurance company, which means that this software can be sold there's a lot of avenues here that could be profit generating. It just so happens that Clover's using it for themselves, right? For its insurance company. So Clover only operates in a few states, right? Will they adapt to other states as well? Yes, exactly. They're strategically going. The ones that went to Florida and all, they burned a lot of cash, right? Those were traps, right? I'm telling you, we haven't even gone to all the states in the United States, let alone other parts of the world. All right, let's continue.
Now, we have been talking for some time about the fact that we would be paid for our PPO plans on 3.5 stars in 2023 for the first time. We're very excited to have been talking about that really throughout last year. And finally realizing that benefit here in 2023. We've talked in the past about how that is an impact of around 300 to 500 basis points. Yeah. But obviously, when you look at the improvement of over 1,000 basis points in MLR relative to our performance last year, there's a lot more that's going on. We haven't quantified each of the individual drivers, but as I said, it is that improved mix of new versus returning members. We have a number of operational improvements that are helping to mature a lot of the back office areas of our still young company that help to contribute some of that incremental benefit as well. We have talked in the past about the fact that another differentiator for our business is the home care business, which we believe to be one of the largest, if not the largest, in the state of New Jersey. And this is a business that allows us to provide a very broad range of services.
Let's go ahead and pause for a sec. So when I was in DC, I saw a lot of Johns Hopkins vans that provided home care. Clover's onto something, okay? Again, all these old folks coming in, you know, what happens if they get dementia? You think they can drive? So I think this is perfect. This is good on them. And I believe Dr. Dhammaranjan, he's Kumar Dhammaranjan, he's from Yale, great man, published New England Journal of Medicine and a bunch of other reputable journals, I believe JAM as well. I think I think they're onto something. That's for sure.
In the home to those members who need it most, and that can obviously have an outsized impact on the medical costs as well, where we're able to impact those members prior to their needing readmission and things like that. So a number of factors that are driving for us favorably, not the least of which, of course, is Clover Assistant and its impact.
When you think about driving Clover Assistant, adoption higher, I guess, how does that work operationally? Like, what do you have to do in your more mature markets to continue to march up penetration?
So his voice at the end was mumbly. I want him to speak with confidence. Just again, this is business, right? When you're a businessman, you're representing a publicly traded company. You want to talk with confidence, right? You just Andrew Toy, I think, does a good job at doing this, because when you give a presentation, there are three types of people. There are people that look at how you dress, and that's all they focus on, right? There are people that basically look at how you talk, right? And then there are third people that listen to what you say, right? Now, I like to hit all three when I give a speech, right? So don't mumble, speak with confidence, okay? And I say this because I know the Clover Investor Relation page watches these videos.
A Clover Assistant, and then as you think about potentially entering new markets, like it seems like it'd be harder to initially have the scale to get physicians to adopt. So how do you overcome that challenge in newer markets?
So first and foremost, we are always investing significant resources in the continued development and advancement of the tool itself. And of course, we believe that the more impactful the tool is, then that obviously will lend itself to greater buy-in. But to the point that you were making a second ago, historically, Clover had really followed a very aggressive growth model, and that growth model really also followed a fairly dispersed geographical expansion pattern. And it is one of the things that is part of our the refinement of our growth strategy and the focus on profitability. We believe that by narrowing the geographic focus of our growth efforts, we will also accelerate the overall level of CA penetration. We believe that CA is a very easy tool for PCPs or physicians to adopt. But having said that, the greater concentration of Clover members that they have in their patient panel, there will be that much more of an incentive, and it will be that much easier for them to incorporate it into their work stream.
Okay. And then on the MA side, you mentioned, the strong MLR improvement that you've seen. Obviously, utilization's been in a huge degree of focus, especially on the MA side. I know that because you have certain geographical concentrations, it's possible you may be seeing a different kind of reality on the ground. I guess give us a sense of what you've been seeing on the MA utilization side, any color you can give across different categories of, utilization types would also be helpful.
Yeah, it's interesting. If you were to go back and re-listen to our earnings discussion when we reported Q1 earnings, we were already beginning to get some amount of question around utilization levels based on, I think, some amount of noise in the marketplace in general. And then obviously there was a significant acceleration in overall industry discussion around utilization levels when we reported Q2. But fortunately for us, what we found is a very stable Medex environment overall. When you look at our medical expenses on a per member per month basis, I think what we saw was a very modest 2% uptick in Q2. On a year-to-date basis, it was, again, a modest 3% uptick in PMPM Medex. Now, there might be some amount of upward pressure on utilization that everyone in the marketplace is seeing, but we also believe that we're well positioned to offset those through our diversification, our diversified value offering, particularly the home care offering that helps to depress that type of upward pressure, and of course the impact of CA.
Okay. Then as we pivot a little bit to 2024, give us a sense of how you approach bids for 2024. I guess what were the company's objectives from a membership growth and a margin perspective? And as you've gotten a better sense of what's out there competitively, I guess how do you feel like the company's position, and maybe how does that compare to what you might have thought a couple months ago?
Yeah, so we don't have a lot of new information to talk about at this point on 2024, the bid cycle. I think the most important thing I can tell you about 2024 is that when we look at the increasing level of momentum we have in 2023, we just couldn't be more excited. Naturally, we came into 2023 very optimistic around the financial trajectory. In our last two earnings reports, in each of those two earnings discussions, we have significantly improved on the full year guidance for the company, and obviously the stronger our jump off point in 2023, then the more optimistic we feel about 2024. I would say that for 2024, we don't have a significant shift in our overall strategy, whether in terms of bids and plan design or anything else. In general, the intent to find the appropriate balance between profitability and growth is still there. I don't want to comment on other industry players' strategy as far as bids or AEP, but we do feel like we're well positioned in the cycle to accomplish our objectives. And we've been making increasingly optimistic comments, I think, around our belief that we have line of sight to profitability on an adjusted EBITDA basis in 2024. And obviously that also comes with it an increasing level of comfort around our overall capital position in the future.
And then, when we think about the risk model changes that are coming from the industry, can you just talk a little bit about what that means for Clover, given your kind of unique take on the market, and how you think about, any potential pressures that could generate, and how you would plan to, offset those pressures if they are?
Sure. Well, I think what is the core of the answer to that question is just a reminder that Clover Assistant is not a risk adjustment tool, and it is not a medical cost management tool. It is a care tool designed to improve clinical outcomes. The logic that underlies Clover Assistant is care-based logic. And so when we think about the behaviors that we believe some of the adjustments in the risk coding model are intending to offset or mitigate, we don't believe that our type of business model is really in the crosshairs of that. And when we look more specifically at kind of some of the granularity of the changes that are upcoming, we don't feel like we are particularly exposed to it. I mean, I think everyone has at least some amount of exposure to it around the edges, but we think that relative to others in the marketplace, we are less exposed. And certainly all of the other favorable drivers that we have coming that are impacting us here in 2023, and we believe will continue to impact us even more in 2024, we look for those to more than offset any kind of headwind from that.
And then to pivot a little bit to the non-insurance business, you've revamped the ACO REACH strategy significantly over the past couple of years. Just give us some context on kind of the company's experience with ACO REACH and the necessity of making that change.
Yeah, and just as a reminder, our participation in that program, which falls under our non-insurance segment, is very young. I mean, Clover overall is a very young company, with its origins, of course, on the insurance or MA side. And then really the non-insurance segment began delivering revenue for the first time in 2021 and very quickly scaled up to over a $2 billion revenue generating segment in 2022. So you can see to have gone from $0 in revenue all the way up to over $2 billion. It's an extraordinary growth trajectory in a very short time. So I think it's reasonable that we would have taken the learnings from that extraordinary growth period and made the decision in the second half of 2022 to then take a step back, as I mentioned earlier, align ourselves more closely with those providers that we had identified that really fall more closely into the strategy of value-based care that we're looking to implement. And those capabilities are capabilities that we're still building ourselves, given.
So I remember, and by the way, just yeah, definitely if you can, I really appreciate you guys hitting the like button. Thank you for everyone who does, for those 14 that hit the like button. I appreciate you, and thank you so much. It helps get the word out, and yeah, it's just, it's nice to be able to have this channel grow and be able to help more folks. I think it'll be very, very great. So I like what he said there. He said a lot of great things, but just one, I really want to stop the video. First off, one of the person here said, are they going to expand in other states soon? He did talk about this, kind of the balance between kind of growth and profitability and how they're strategically going to basically expand. And another thing is very, very, I want to basically hit is, I remember in the stock terminal, we had a couple of folks were commenting saying, hey, you know what? The Clover membership is actually decreasing. I'm a bit worried. Well, the reason why it was decreasing is because, Clover is really selecting for physicians that really utilize the Clover Assistant platform. And for the ones that are just taking advantage of Clover by just getting their money and just wasting it, then okay, well then go find, we're not, just go find another insurance company, right? Go somewhere else, right? Which sucks, but it is what it is. Again, we're trying to build something here, and it's gonna basically come with very tough decisions. You just, as a leader, you have to make tough decisions. Okay. But I really like that because now they know kind of a metric, almost like a checklist. And hopefully by like a month or two, they're able to determine if this patient or this doctor is going to be a good Clover Assistant doctor. And I'm assuming they're developing a model for that so they don't burn cash, right? So I do believe they're getting to that. I believe I would look at the other, look at the earnings report, but I know it's greater than 500 million. I think it's greater than $600 million, but it's at the end, close to the end page of the last quarter, quarterly earnings report. So I'm just checking my phone here. And then also for the book, yeah, I think I'll be able to beat The Wolf of Wall Street if I create an audio book for sure. Yeah, I definitely agree. Oh yeah, for sure. Let's see. Let's go back and continue.
And the newness of the program. And of course, our expectation is that over time, there will be an increasing impact from the deployment of Clover Assistant amongst that population as well, as the providers that are partnered with us under the program continue to ramp up their own usage. And the efficacy of the tool obviously is one that improves over time, and with the maturation of the population and provider group that we maintain, we can expect to have an increasing impact over time.
Okay. And how do you think about financial performance of this business over the next couple of years? Like, do you think stability is probably the way to think about it, and then based on that you can decide how much you want to grow or not grow in this business? Or I guess what's driving your decision making on whether to grow more in this business in the future?
Yeah, I would say in the immediate term, it's more about a strategy of patience as we allow for that line of business. And I'm speaking here specifically around the non-insurance segment. It's around allowing it to mature, our own capabilities to mature. So I wouldn't say that we are in the immediate term back in any kind of a growth on mentality. We had talked beginning last fall, about targeting to make that business for the first time a gross margin positive business, which it had not been during the early part of its history. And when you look at the year-to-date performance of the business, we've achieved that. So just on a year-over-year comp basis, that improvement and the achievement of gross profit positivity for that line of business is an important part of our overall step change improvement as a company.
So that's actually really important. So let me just go ahead just really quickly here. And let's open up our Wall Street tab here. I'm sorry. Let me just kind of stop sharing screen here. And let me share with you this screen here so I can open up the Wall Street tab. Because again, I want this to be interactive. You could just watch the video on your own. I want to be able to give you this. I think I should have hit all caps, but I think we're good. Okay, good. So he was talking about gross profit ratio. He said that gross margins used to be negative, and they definitely used to be negative for sure. And look at them now. they're between the 15. They're in between the 15 to 20% range. I would say 15%. So that's really good. They're getting better. If you look at free cash flow, they are getting closer. They are getting slowly closer. Okay. All right, let's go back. Let's go here and share.
And I think we'll just look in the immediate term to continue to mature the capabilities there before we go back to more of a growth on mentality.
And earlier this year, you announced an agreement to move many core health plan operations to UST HealthProof. Just walk us through the decision-making process there about why that was something that made sense. I guess operationally, what is required to make that a smooth transition. And then as you think about the financial benefits of this, I guess how significant are they? Are they fully realized in 2024, or is this more of like a multi-year initiative?
Yeah, it's a great question, and as a reminder for those that weren't following the news cycle over the last.
That's actually a good question for folks. I think it's going to save them $30 million in free cash flow. So one of these days, Clover Health is going to invite you. So actually, Clover Health already knows about me. I've spoken to the chief scientific officer. The issue is because I'm covering them financially, it's hard to participate from a scientific perspective because it could be looked as bad science and a potential lawsuit. But the thing is, I already know who they are. I've already spoken to Toy and then Dr. Dhamarajan, great people, ensure journalistic standards and to make sure that I'm not biased. Hence why I've been able to call them out, and they've obviously listened. Right? I said, hey, we created a change document and said, hey, can you please be a little bit more transparent? They're posting a lot now. Can you talk about more about AI? They're doing that now. So they are listening. So it's good to be, again, if you guys have any issues, let me know. Some of the issues are stupid. I won't say anything, but if the issues are good, they're warranted. I believe it was a good to back retail up in terms of transparency. But again, when the stock was going around 72 cents book value, like no brainer at all. And I'm so thankful as well. All right, let's go back.
Year. Looking for optimization opportunities around SG&A and OPEX overall is something that we've been talking about as part of the overall path to profitability discussion that we began to be more vocal about beginning in the second half of last year. And so we've talked a lot so far this morning about the improvement in MCR on the MA or insurance side of the business. We talked about achieving gross profit profitability for the non-insurance or ACO side of our business. And the third lever, of course, is around SG&A and OPEX. And given the extraordinary growth trajectory of the company historically, you could probably imagine that our expenditures on SG&A had also grown at a very aggressive pace. So certainly it's easy to see that there would be optimization opportunities in there. I believe it was in April of this year that we announced some cost-cutting initiatives that were going to have an immediate impact on the business, but primarily it was this back office transformation project in partnership with UST HealthProof that you just mentioned that we expect to be the value driver over the longer term. When we reported Q2 just a little while ago, even though the transition over to UST isn't going to take full effect until the beginning of 2024, we already saw about a 7% reduction in SG&A year over year for Q2. So that you can see that not only have we stopped the growth in SG&A, we've already begun to deliver some value in terms of savings from these other initiatives. But we did cite the expectation that we would achieve a total of about $30 million in run rate savings beginning in early 2024 with the culmination of that transition. At the risk of saying the obvious, it is a very kind of comprehensive transition and impactful transition in terms of our back office insurance operations. The most important thing that you want to be cognizant of is risk mitigation during a period of change, and that is the biggest priority for the team. But ultimately, we remain very comfortable with the pace and execution around that project, and remain comfortable around the overall value that it's going to be delivering. And as a reminder, in terms of what we're actually transferring over to the UST team, it is what we would refer to as our non-core back office operations. When you think about everything that makes us special, our differentiators, whether it's our Clover Assistant and the continued investment in Clover Assistant, the overall strategic direction of our insurance or non-insurance operations, the home health business, and some of the other differentiated capabilities that we have, obviously we are still maintaining all of that in-house. And really what the partnership with UST HealthProof gives us is the opportunity to partner with someone who has already achieved an extraordinary amount of scale in terms of the number of members that they're serving, and us still being a relatively small plan, we can now tap into the scale that they've achieved for some of these non-core operations.
Okay. And as we think about your target for adjusted EBITDA, from your guidance this year and your targets for next year to get to profitability, so it sounds like some component of the $30 million is part of your thinking. in terms of the savings there. Doesn't sound like maybe necessarily we should expect a big change on the non-insurance side of the business. And then seems to think then that the largest part of the step up there is going to be probably from the NA profitability. Is that the right way to think about it? Are there more levers? What else should we be keeping in mind?
Yeah, I want to be cautious because we are, it's very early in our process to be issuing guidance or more concrete expectations for 2024. As I mentioned earlier, we are increasingly comfortable that we have line of sight to adjusted EBITDA profitability next year. I think in terms of those three major categories of levers, what you laid out is reasonable as far as kind of the size of the prize in terms of being able to move the needle next year. And we think we have a lot of important momentum behind us in order to achieve that.
Okay. And then, in the market, there's obviously a huge amount of focus on star ratings, and we're going to get some more, star ratings news in the next couple of weeks on, 2025 payment year. Just remind us where the company sits today in terms of its star strategy. Is there an expectation over time, the company could get over the hump and get to that, 4-star rating? And I guess what are the key areas of, the company's star ratings today that have prevented it from getting there? And I guess how are you guys getting after that?
Sure. Well, great question. And I did mention earlier that.
So, I want to basically say this, the analyst here is actually pretty damn good. The Wells Fargo analyst has been asking some pretty damn good questions. I'll give him about a 92%, 93%. There was 1-2 questions that were stupid, but the others have been, I give him an A. This analyst is on point. I definitely like him. Is good questions.
For 2023, we're very pleased to be paid for the first time at 3.5 stars for the PPO side of our business, of our insurance operations, which is by far the majority of our membership base. We are also similarly excited that we will be paid in 2024 on 3.5 stars for our HMO, which may be a smaller part of our business, but still should provide some amount of incremental tailwind for us in 2024. We're not specifically targeting a timeline for achievement of any other stars level, but what I can tell you more broadly is that, one of the attributes around our membership base and Clover historically has been that we serve a very diverse population. And when you listen to some of the directional comments from CMS over time around achieving greater levels of health equity across the Medicare and Medicare Advantage ecosystem, we really believe that the overall direction of that program is going to favor plans like ours that have a more diverse membership base. And so certainly we're hopeful that that's going to be advantageous to us in a number of different areas, including in terms of stars. But as far as our
So we've already known this before. Clover Health likes to basically help patients that are historically marginalized, patients that live in a high index of need-based care. And Clover Health is basically, that's their goal, right? That's their target population. Historically, other insurance companies don't like to go there because, again, these particular people tend to be high users of insurance, relatively have a little bit more comorbidities and higher mortalities, and by a factor of 5 to 10 years in terms of life expectancy, less than that of a wealthy population, let's say in the coast of California, in Malibu, to give a few examples, right? It's great because CMS, which is the governing body agency here, it's pretty much the government. They and it's also my medical school and medical schools around the country. We're basically being taught ways on how to decrease the social determinants of health. What are ways that we can do as healthcare providers to tackle on these diverse populations that unfortunately just live in an area that and economically live in a country that unfortunately values the rich over the poor. And that's, pretty, about 50, 60% of the world probably lives like that, probably even more. And CMS wants to reduce that. And Clover is basically in that arena. So as CMS basically gets to that level, and it certainly will, Clover is going to have its hand out and say, well, I'm already doing that. And it's going to get rewarded. Okay. All right, let's continue. That's what this guy's trying to.
Our overall economic trajectory, our objective is to achieve profitability without needing to achieve 4 stars. And so certainly being on that kind of 3.5 star chassis now is an important stepping stone for us. And then we believe that the other P&L levers that we've got that we already discussed will be enough to get us to a profitability on our adjusted EBITDA base.
Yeah, another question I had, it kind of relates a little bit to that. Like, you've had improving stars. You've been, especially in your core markets, you've been a key player for a number of years now. You're no longer kind of a new face in the room. I guess, how has that changed your relationship with brokers and distribution channel as they've seen you as a more stable and consistent part of the ecosystem?
Yeah, absolutely. And in the markets that we operate, especially during this period over the last year, where we are now seeing just an overall maturation of our portfolio, that certainly is going to have a favorable impact on your relationship with all of your various commercial channels. And I think we've always had a very successful and collaborative relationship with the broker network that we work with, and certainly see the opportunity to build on that over time.
Exactly. So that question basically is a thumbs up, a star, smiley face, when you get in elementary school because you did a good job. Pretty much was asked, now that you're a stable company and people know that you're reliable, that you're not going to go bankrupt, essentially, how has your relationship changed with, Wall Street, with the purse? And of course it's changed as what Scott was saying here. Very excited for that because that's it. It's Wall Street says, okay, this company's pretty much good. This is it. This company's here to stay, and let's give it money. That's it. It's time to grow. So this is pretty good, right? Pretty good.
Is there any, as you guys again have matured a bit, have you seen any change or inflection in your retention of membership, or how's your retention levels, trended over the past couple of years? And is there any thought to how that might look in 2024 if there's maybe more shopping across the market as a whole?
We don't publish or disclose retention data specifically, but overall, I think when you look at the program that or the plan design that we offer to our members or potential members, the fact that we're on this the wide network PPO construct, which is so attractive to such a wide range of the marketplace, I think it's difficult for them to find something that competes with us in terms of from a choice standpoint. And I think that we offer a very attractive plan design overall, supplemental benefits and so on. And so I think that's always impacted us favorably from a retention standpoint. We'll look for that to continue to favorably impact us.
Got it. And then as we think about the company's improving financial profile both this year and hopefully into next year too, can you talk about the interaction of that with your expectations on transitioning to to positive free cash flow, and where the company sits today in terms of a capital and liquidity?
He said my favorite word. Positive free cash flow. He's like, oh yeah, when next year when the company transitions over to positive free cash flow, baby. Woo! That is my favorite word. Right? And what I've been saying. I've been saying this since 2021. I've been saying this since Minnesota. What I've been saying. Estimation of positive free cash flow. Estimation of positive free cash flow. Estimation of positive. I've been saying this every single effing video. And here it is. I'm going to repeat the question because I like it. I like to hear. I like it.
Such a wide range of the marketplace, I think it's difficult for them to find something that competes with us in terms of from a choice standpoint. And I think that we offer a very attractive plan design overall, supplemental benefits and so on. And so I think that's always impacted us favorably from a retention standpoint. We'd look for that to continue to favorably impact us.
Got it. And then as we think about the company's improving financial profile both this year and hopefully into next year too, can you talk about the interaction of that with your expectations on transitioning to to positive free cash flow, and where the company sits today in terms of a capital and liquidity perspective?
Sure. Well, we have been talking, I want to say we began referencing also in the second half of last year that when we looked at our overall capital and liquidity position, we felt comfortable that it was more than adequate to support us through our 2023 operating needs. We have reiterated that a number of times, and obviously with the increasing outlook that we continue to report relating to 2023, we throughout the year have become increasingly comfortable with our near-term capital position. And then as we have become more comfortable also with having line of sight to profitability on an adjusted EBITDA basis for 2024, we have also expressed that we're increasingly comfortable that we'll be able to reach that profitability without requiring any incremental capital. As a reminder, in terms of our total liquidity position with cash and investments, on a consolidated basis, as of Q2, we reported around $700 million or so of total liquidity, cash and investments. And then even at the parent or unregulated level, we reported around $300 million or so. So when you look at that relative to our run rate cash burn and the achievability of profitability in 2024, we are becoming increasingly comfortable with our overall capital position.
Okay, great. And then as we think about, the regulatory landscape or policy landscape and things in DC, I guess, is there anything that you would highlight that the company is especially focused on advocating for, or in general, when you think about, expectations around like, rates and reimbursement for the next couple of years? It feels like we have this known item around, the risk model phase in, and that leads me and maybe some others to think that maybe there's like less likely to be disruptive change over the next couple of years. I guess, big picture, like what do you guys look for, and what do you think are the most meaningful things on the regulatory side to stay focused on?
Yeah, well, I mean, certainly we've always been an advocate for the overall direction towards health equity, like I was talking about earlier, because we think that there is so much of a population, including the population that we serve, that can benefit from that overall trending from a policymaking standpoint. As I mentioned earlier, some of the changes around the risk coding structure, we think are really targeting other parts of the market landscape as opposed to where we sit. And so I think that we are in the fortuitous position right now where the value drivers that we think that we bring, our differentiators, are areas where we can really control our own fate as opposed to relying on any kind of particular policy change or direction. And so we're focused on delivering and capitalizing on that value now. And we think that really, when you look at our year-to-date performance, it really shows how much we can achieve and how much more we are hoping to achieve in the quarters and year to come.
And last question, kind of an open-ended one. When we're sitting here a year from now, what do you think people will realize about the company that they don't realize today?
Well, this might be a good time to make a plug for Clover Assistant if I hadn't done it enough yet. But I think that as our financial performance continues to improve significantly, for us, it's that much more important that all of our stakeholders become more intimately familiar with Clover Assistant and the value that it brings. And so we are planning to conduct a Clover Assistant Spotlight event that we encourage everybody to tune in for, including you. And we'd love for people to take this opportunity to look at this overall step change improvement in financial trajectory for the company and understand how Clover Assistant is an integral part of that. And that's something that we don't have a specific date to announce for that yet, but we expect it to occur in the near future. And that's something that hopefully people can use as a stepping stone into 2024, where our objective is to continue to deliver improvement in financial performance overall. And I think as people see more of those proof points with the foundational understanding of the value that Clover Assistant is bringing, I think it helps people to bring the pieces together and understand why we are so optimistic around the future of the company.
Okay, fantastic. That's a great place to leave it.
All right.
Thanks so much for your time today.
Appreciate you having me.
Okay.
Okay, guys, very, very, very excited. I mean, like, seriously, guys, to go in and pretty much talk about this company when no one basically is talking about it, to cover this company where you're the only one covering it and Wall Street's basically quiet. Wall Street knows. They know. Wells Fargo guy said it. He's like, yeah, when next year when you transition to, to positive free cash flow, tell me a little bit more about that. Ladies and gentlemen, I've been talking to you guys about this. And if you look at my other videos, I said late 2024 to 2025 and onwards, I have a positive outlook. Those were my calculations. And look at that. Look at that. So, and the proof is in the pudding. I mean, the proof is in the pudding. I mean, holy effing moly. My book is right next to Wolf of Wall Street, and it's ranked in the top 100. And, I've been doing this for such a long time that I'm going to be posting a new book on how to find the next 100, the next 10 bagger, how to, 10x your investments. And this will be the title of the book. It'll be going out probably in a week or two from now, probably earlier, hopefully. But I recommend obviously picking up this book, $15. I mean, come on. I think I get $5 or $4 and that goes to charity. So, I mean, I think Amazon takes everything, and Barnes and Noble and all the other ones. But yeah, guys, I mean, this is huge. I mean, it pretty much just said they're going to transition to positive free cash flow, which we already know about, right? I remember a lot of folks were arguing with me, the keyboard warriors on YouTube. You don't know what you're talking about. You don't know about what are you estimating free cash flow. That's not how you do it. I mean, I'm like, all right, dude, don't talk to me, man. Don't watch the video, right? I'm here to teach people. Again, I may not have I used to do the beautiful graphics and the beautiful little things on top and, making a video fun and appealing. But again, guys, I don't have time for that. I'm trying to become a brain surgeon, right? I'm not trying to become a YouTuber. I'm not trying to become Mr. Beast, right? This is a long form video for people that are serious, for people that really want to learn. And this is, this is how life is. If people want to learn, this is a long lecture format. It's a discussion. And I'm very grateful for people, that are on here right now. Well, it's 53 people. I'm grateful for each and every one of you. If you could take a second, hit the like button. If you're not logged in, don't worry about it. It's a bitch to do that. Don't worry about it. It's a big deal. I mean, to have you guys on here, this long video. But again, you see the quality in our video. You see the quality in our projections. You're seeing everything I'm saying makes sense. I mean, it's not, this makes sense. I hope, you the GOAT. Honestly, I'm not the GOAT. You know who the GOAT is? This guy. Not him for a sec. Leave him for a sec. Get out of here, Warren Buffett. Get out of here. Stop smiling, right? No, this guy's the GOAT. This guy is the Muhammad Ali of investing. This guy made this guy. If you don't believe me, watch this. I'm about to watch this. Are you ready? Are you ready? Who was the mentor of Warren Buffett? Look at that. Benjamin Graham is the mentor of Warren Buffett. Who's Benjamin Graham? This guy right here, right? So the real GOAT is this guy. And I'm going to teach you guys how to be a GOAT, right? Man, right? Or is that's a GOAT, right? Yeah. I skipped kindergarten in first grade. So I don't know those things, right? Just kidding. All right. So any of you guys, I think that was a lamb. Yeah, guys, this means the world to me. Again, you can pick up the book on Amazon, or I think I added the link down below. And let me just kind of give a shout out to the book, because again, this book is going to help. It's going to help scientists around the world be able to publish, and be able to do science and discover things that will ultimately help the patients that are in neurosurgery. So here is the book. Again, it's $15. If you guys want the hard copy, don't even get the hard copy. Get the paperback, okay? It's the same damn thing. Do not get the hard copy. Get the paperback. It's like $14.99, okay? It's there's the link. The $15 book. And then when my other book comes out, I'll let you guys know. And then for those that are interested in this $15 book, then you guys can look at the other stuff that I have, because you guys are gonna be like, wow, if this is $15. Imagine the other stuff. No, I'm so happy that you got the book. The first 2 chapters are good. That second chapter, you're gonna see a graph that I went ahead and orchestrated, and you'll basically see that when inflation is over 6%, stock market returns go down. But when inflation is under 6%, stock market returns are good. But when inflation is below 0%, stock market returns are bad. So you'll have all these little tricks. And then if you go to chapter 3 and 7, it's like crap. It's like hard to understand with bonds. But if you go to like chapter 8 and on, it's going to be very good. You're going to learn so much. Okay. And yeah, I'll be honored for you guys to get this book, $15, and buy more than one book. Buy one for the holidays for your friends. Again, this is going to go to charity, right? This is a book that's going to go to charity. I'm not taking $1. This is a book, and once you guys get it, I would love if you guys can review it. It actually helps the book even more. Again, I think this book is cheaper than the alternative. I believe there was like another person's 5-star book. Hey man, I really appreciate it. I think the other, like the original, so the 1949 Intelligent Investor, this gentleman wrote. What I did is I just wrote it in a modern way. Instead of saying "herein then lies the chart," I mean it's hard. We don't speak in those terms. So I wrote it in terms that people can understand. Okay. I had just got past the bond part. Seems I just got to the juice. It seems exactly. Once you basically get past that, you're going to get to the juice. You're going to get to the secret of life, the golden nugget. Imagine so many people have picked up the Intelligent Investor. They literally stop reading it after the 3rd chapter and they close it because it gets so complicated. They don't understand. And maybe Benjamin Graham did this on purpose. Once you go into chapter 7 and 8, after 8, the book turns into a gold mine. And then it's the epitome of life. You cross the mountain, and the people that persist, they soar, right? So yeah, look at PAG, PE under 9, 8.91. Yeah, I mean here. So, you could post it in our stock terminal. What you can do is you can go here, type in Wall Street. What is it? PAGS. You go here. Oh, processing. Let that process. And here's the financials for the company. You said the PE is 9. So where's the PE? Price to earnings. Yeah, so it's around 9, as you said. Free cash flow, positive, good. That's what I'm talking about. Revenue has grown. Net income. Hey man, looks like a good company to me. Shares 327. So very quickly, it just shows you how fast our stock terminal is now at doing this analysis. So we can go here. We can open up the mastering stock market intrinsic value calculation. Where the hell did I put it? Let's go here. Free cash flow. Again, usually you want to estimate free cash flow. I'm going to just do one good one and one bad one. So we're going to do like the best, which is 1413. So we're going to put 1413. Doesn't matter. Just take the average. We're going to go 10 years. The growth rate, I don't know. I mean, I'm just going to go. We can just do the, was it 26 million? We could put 26 million here. What year was this? It was in 2014. And then what do we have here? Was it 1505? 2023. Growing at 57%. I doubt it. I mean, in 10 years. I mean, yeah, I guess. It looks pretty good. I don't know what the company does, so you got to do that analysis as well. The shares 327, so we'll do 327. Okay, so then now that's how I know the growth must taper. So you could do a little trick here. There's another way to calculate this, but we could do a trick here. We do a PAG. We ought to make sure if this is a U.S. company too. Go to analysis. Then you go estimates 11.3%. So we can put 11.3 here. And we can do that. And then I just want to know, because this doesn't, I've never heard of this company. Let's see what it does. Based in São Paulo, Brazil. Yes, I would usually when it comes to these companies, I need to be a little careful. I usually do extra due diligence on these companies because, again, it's not from the U.S. But yeah, I mean, it's looking pretty good. I think these are in USD. I would have to do I need to be careful because this might be in Brazilian money. I need to double check. So the thing is, Michael, I don't listen to Zach's. I do my own analysis, right? Zach's, I had a friend named Zach, and he wasn't a good friend. I'm just kidding. But yeah, I like to do my own analysis, right? Who cares about Zach, right? It's Zach. Let's see here. So let's just kind of go. I just want to do one little quick only thing because it isn't in the financial sector, and you have to understand the financial sector is kind of rough right now. But I want to just double check. Yeah, like I said, like I thought, it's in Brazilian money. So you would have to basically convert all this into Brazilian money, right? So you would have to take 1413, 1413 1413 BRL to USD. So it's about $290 million. So you do 290 here. And then you want to do the shares is the same, but yeah, that's it. So then this is the price target right here. So this is the price. So because as soon as I saw the numbers, that's how you know I've been doing this for a long time. I saw the numbers. I'm like, these numbers don't make sense. These numbers just don't make sense. It's in Brazilian, okay? Because I'm like, I would have heard about this company, right? $1 billion in free cash flow. I would have heard about it. It's 290 free cash flow. So yeah. So on average, the stock recession level 7, a bear is 12, a base is 16. You said upgrade to 14 makes sense near the base. And the upper bound is 22. So I haven't even, by the way, have I looked at the price of the stock? I haven't looked at that's how I do my analysis. So let's go ahead and do PAG stock. It's currently trading at $8. And just to show you the power of the Mastering Stock Market course and my proprietary intrinsic value calculation, the 52-week low is $7.51. Now let's go to here. What is this right here? Look at that. $7.13, literally right next to the $7.50 recession level. It shows you the power, right? And then the 52-week high is $16, which is, well, look at that, the base, right? But let's go ahead and let's kind of zoom out here. Let's just look at the max here. Yeah, so something happened here. You want to go ahead and investigate what happened in 2020. I think we know what happened in 2021. All the stocks went berserk, and you can automatically see stocks went above its intrinsic value multiplied by 2. So this obviously would have protected you. So yeah, just do some analysis on that. Obviously, it needs more analysis than what I just did. But again, I just wanted to do something real quick. But again, here's the thing, Michael. I want you guys to be able to do this. That's why I basically created this book. That's surprisingly is right next to this guy here. Like I would never imagine my book. I have more respect for Leonardo DiCaprio than the actual Wolf of Wall Street. I think the Wolf of Wall Street scammed people. But that's the point of this book, and also it's the point of this future book I'm going to publish, and obviously it's also the point of our Mastering the Stock Market course, which you can see here. I missed it here, right? Let me go ahead and share. So essentially, the goal that I'm trying to do here, guys, is I'm trying to teach you how to do this on your own, Michael, right? That's the goal, right? I want you guys to be able to do this. I don't want you guys have to rely, look at this stock, look at it. I want you to be able to say, I know what I'm doing. I can do this on my own, right? And then you'll know more than 95% of the people. I'm probably even more. Go talk to the guy, Joe Schmo, around the street. And, if I go outside right now and I can say, do you know what intrinsic value calculation is? They're going to be like, are you smoking crack? Right? That's just how the way it is. And again, we're teaching you that, guys, this information. And it just shows you, I mean, like I just basically calculate the value of a stock, right? You would think that I would have more followers, but it just shows you how this information's so hidden, right? It's just not, society doesn't know because it's in these books that are old books that I'm trying to modernize for you. But then people have been trained, like for example, Apple has been trained to say, hey, you know what? You should get the new iPhone 15. Hey man, my old iPhone is great. I'm okay with an older iPhone, right? But no. It's newer. It's better to get the newer stuff. But people don't understand that we're still using a constitution that was written 250 years ago. If we're still using a constitution that was basically written 250 years ago, so the point is sometimes you have to look in the past to connect the future, right? People don't like to study the past. And that's what we do. I just looked at the past performance of the company, did an intrinsic value calculation, project the past performance to the future, and did a discount rate anywhere between 10 to 20%. And then that's what we do, right? So anywho, if you want to access the Mastering Stock Market course, there'll be a link down below, or you can go to alstocktrades.com. If you want access to our book, which will be donated to charity, it's $14.99 paperback. I recommend getting that one. You know where to find it. It's on Amazon. There's also a link down below, right? I appreciate each and every one of you guys. Again, the whole point of this is to help you. again, this is not to make money off of you. That's not the goal. I'm going to become a brain surgeon. The goal is to help you. The goal is to help my subscribers. The goal is to teach you something that is unfortunately not taught. The only reason why there's a charge in the Mastering Stock Market course is it costs money for me to run it, right? I have to pay money for the data, and I have to pay money for developing the data. And then we also have other softwares like Tradealytics, which costs $69 for you guys every month, which is, and I'm charging lifetime with $1,500. I mean, plus the $200 off. And then there's the OpenBB, which is another thing, and all the other stuff. So again, the value's there. If you actually calculate what we offer, you would actually see I'm in the net negative, right? But that's, again, the point is I'm trying to build something that I would use so I can detach myself from the Bloomberg terminal, because I don't want to pay $2,000 a month, right? So that's kind of the goal that we're trying to build here. And so that's really the point. Again, it really means a lot to me, guys, to support, to support you guys on this, and to really honestly have a team of people that are on the terminal that we can talk to and really have like-minded folks. And I hope in the future we can have conferences kind of like the All-In Summit. Like I'm talking 10 years from now, we can have a really nice conference and just really be able to have a premium on the conference, so we can have a pot of cash where we can be able to get some really cool folks to come and give us a talk and really have a great time with that. So, the future is our oyster, but the first step is teaching you guys how to do these analysis and be able to take the training wheels off, so you guys can do you guys can run the show, right? Because that's the point, right? I don't want I don't want to be the person who sits behind the magic curtain and says, to do the analysis, you have to come talk to me. No, I want you to do it, right? So that's the goal. And after earnings, the book value, I'll take a look at the book value. It seems that the book value went from $35.93 to $38, and I believe that is in USD. No, that is in Brazilian money. So whatever the Brazilian ratio of that is. But all right, pleasure, and I'll see you on the next one.